imagine you only have like $5,000 in the bank. I mean, for most people, that's barely an emergency fund, right? It's certainly not $1 million.
Right. It's definitely not retiring on a yacht money.
Exactly.
Wow.
But what if I told you that exact amount is enough FU money to walk into your boss's office, demand a 6-week unpaid leave, and just go bike across Ireland?
See, it sounds impossible because we're so conditioned to think wealth is this, massive, unattainable number that's only reserved for Wall Street insiders.
Yeah.
But that $5,000 cushion completely shifts the power dynamic between you and your employer. You're no longer desperate.
Welcome to Wealth Builder Books. Today, we are totally stripping away the jargon, the intimidating math, and honestly, the aggressive sales pitches to give you a masterclass in true wealth-building strategies.
We're doing a deep dive into the core ideas
Yeah.
from J.L. Collins' phenomenal guide, The Simple Path to Wealth.
And if you're sitting there right now thinking, I knew I should invest, but I had absolutely no idea how to start, or I'm terrified of losing my money, this conversation is built specifically for you.
Yeah, we're going to prove that the highly complex financial advice you usually hear is largely just a marketing trick. Achieving financial independence is shockingly simple.
Okay, let's unpack this. Where do we even start?
Well, we have to begin with a complete philosophical shift. Like before we even touch on stocks, bonds, or retirement accounts, we have to look at why you're building wealth in the first place.
Right.
Because the prevailing narrative out there is that the goal of wealth is luxury, upgrading your lifestyle.
Buying the yachts, the mansions, the fleet of sports cars. But the source material opens with this fantastic parable that completely flips that script. It's the story of the monk and the minister.
Oh, I love this one.
It's so good. So 2 childhood friends grow up, right? One becomes this humble monk, and the other becomes a rich, powerful minister to the king. Years later, they meet up. The minister's in his fine robes, looks at the monk in his shabby clothes and says, if you could learn to cater to the king, you wouldn't have to live on rice and beans.
Right, just submit to the system to get the material rewards. It's the exact trap so many of us fall into. We take on massive stress to afford a lifestyle we, frankly, barely have time to enjoy.
Exactly. But the monk looks right back at him and replies, if you could learn to live on rice and beans, you wouldn't have to cater to the king.
And that right there is the absolute bedrock of financial independence. Wealth isn't just about expanding your assets. It is equally about controlling your needs.
Yeah.
If your lifestyle always matches your income, or, exceeds it, you are essentially a well-paid slave to your paycheck. You are constantly catering to the king.
Which brings us back to that $5,000 FU money story from the book's author. Having that small cushion allowed him to dictate his own life choices.
It bought his freedom, not stuff.
Exactly. And later on, as that financial cushion grew, it allowed him to let his wife quit a job she felt obligated to keep. Instead of grinding away at an office, they spent hours building Lincoln log cabins and watching The Lion King with their young daughter.
Wow.
Yeah, he actually told his wife, what could we possibly buy with the money that would have more value than you being home?
That's powerful. And the thing is, the financial marketing machine intentionally blurs the line between our wants and our needs to prevent you from ever reaching that point.
Oh, 100%.
We are relentlessly bombarded with messaging that tells us we simply must have the latest car, the newest phone, the bigger house, and if you don't have the cash, they have a really convenient solution for you.
Finance it. Take on debt.
Exactly.
I have to put my own spin on the author's warning about debt here because it is just so visceral. Carrying consumer debt is literally like walking around covered in leeches.
It's a gruesome image, but mathematically, it's incredibly accurate.
Think about the mechanics of it. When you're paying 18 or 20% interest on a credit card, but you're only paying that like $10 minimum payment they so helpfully suggest, almost none of your money is actually paying off what you bought.
Right, you're just paying for the privilege of owing them money.
Yes, you are letting the financial industry drain your lifeblood. You're bleeding out slowly, and they are getting fat off your future labor.
Debt is an unacceptable burden. You just have to scrape those leeches off before you can start moving forward. So the foundational rule of the entire strategy is simply this: spend less than you earn, invest the surplus, and avoid debt.
Wait, hold on. I want to push back and ground this in reality for a second. Scrape off the leeches, spend less than you earn. That sounds great on paper. But for someone dealing with skyrocketing rent and inflation today, finding a surplus feels honestly impossible.
That is an incredibly important point, and it's an honest limitation of any financial book, including this one. The math assumes you can actually create a gap between your income and your expenses, sometimes even suggesting a 50% savings rate.
Which is huge.
In today's economy, that is brutally hard. It might mean taking on a side hustle, radically downsizing your living situation, or, aggressively upskilling to increase your income. The book's path is simple, but simple does not mean easy. The discipline required is immense.
Right. But assuming you fight that battle, you scrape off the debt, you control your needs, and you finally have a surplus of cash, where does it actually go?
The book points firmly to the stock market.
Now, for a beginner, the market is terrifying. It's just a sea of red and green arrows and people screaming on financial news networks.
It is entirely designed by the media to look complicated and scary. But the author provides this brilliant reframing tool to help you visualize what you're actually buying.
Oh, the beer and the phone. I love this analogy.
It's the best.
So imagine pouring a nice cold mug of beer, the dark, dense liquid at the bottom. The actual beer represents real-world operating businesses. Apple, Microsoft, the grocery store down the street, the companies making your toothpaste and your car tires.
The stuff we use every day.
Right. These businesses produce actual value, they innovate, and over decades, their collective growth relentlessly drives the market upward.
The beer is the substance. It is human ingenuity constantly striving for more profit.
But on top of the beer is the foam. And the foam represents the daily price fluctuations in the stock market. The panic, the volatility, the talking heads on TV declaring the end of the world one day and a massive boom the next.
And you have to consider why the media hyper-focuses on the foam. It is entirely driven by human psychology and media economics.
Because boring doesn't sell.
Exactly. Nobody's going to sit glued to their television to watch a rational person discuss the slow, decades-long compounding growth of American business. It's boring. But if a pundit promises the market's going to crash by Friday, you have a captive, terrified audience. The media monetizes your fear to sell advertisements.
But wait, if I'm watching the foam and I can clearly see a massive crash coming, which, happens, why wouldn't I just pull my money out, let the market hit rock bottom, and buy back in? It seems crazy to just sit there and watch my life savings drop by 30%.
It is the most tempting thought in the investing world, and it is the single biggest trap. What you are describing is market timing. To successfully time the market, you have to be right twice.
Right, twice.
Yeah, you have to perfectly guess the top to get out, and you have to perfectly guess the absolute bottom to get back in.
And if I miss the bottom,
then you end up buying back in at a higher price than you sold, completely locking in your losses. The source material is adamant about this.
Yeah.
Nobody can consistently predict the market. Not the guys on TV, not the mutual fund managers, nobody. Think about it. If someone could actually time the market with precision, they would rapidly become the richest person on earth because they'd just be compounding infinite wins.
So all those complex investments and market timing strategies being sold to us?
They exist solely to extract high fees from you. The financial industry makes billions by convincing you that you need their active management to navigate the terrifying foam.
But we don't.
You don't. You just need to buy the beer, except that the foam will sometimes spill over the glass and ignore the froth.
Okay, before we get into exactly what to buy, I want to take a quick second to remind you that if you're finding this breakdown helpful, we've linked J.L. Collins's The Simple Path to Wealth in the description below. Using our affiliate link is a great way to support Wealth Builder books so we can keep bringing you these deep dives.
Absolutely. So, moving into the actual mechanics of investing, the book breaks your financial life into two distinct stages: the wealth accumulation stage and the wealth preservation stage.
Let's start with accumulation. This is for you if you are actively working, building your net worth, and are, years away from retirement. The advice here completely defies conventional wisdom. It's 100% stocks.
Yep.
Specifically, a Vanguard index fund called VTSAX. That's the Vanguard Total Stock Market Index Fund.
Yeah.
No bonds, no gold, no complex real estate trusts, just VTSX.
And the immediate reaction most people have is panic. We've all been taught the golden rule of investing, right? Don't put all your eggs in one basket. Putting every investing dollar into one single fund sounds reckless.
But the reality is, VTSAX is every basket. When you buy a share of VTSAX, you aren't buying one company. You are buying a tiny piece of virtually every publicly traded company in the United States. You own a piece of Apple, a piece of Exxon, a piece of thousands of mid-sized and small companies.
And here is the hidden mechanism that makes an index fund so incredibly powerful. It is self-cleansing.
What do you mean by self-cleansing?
Well, if a company in that index goes bankrupt, it simply drops out of the fund. When a new explosive startup goes public, it gets added. You are essentially betting on the overall success of the American economy, which inherently includes massive international exposure since these are global companies.
Okay, but why Vanguard specifically? I mean, there are thousands of investment firms out there offering index funds.
It comes down to ownership structure and conflicts of interest. Look at a typical Wall Street investment firm. They have to serve two masters. First, they have to serve the investors who buy their funds, who obviously want high returns. But second, they have to serve the corporate owners or public shareholders of the firm itself.
Ah, right.
And those corporate owners want high profits, which means charging the investors high fees.
So the firm's profit comes directly out of your returns. It's a structural conflict.
Exactly. Vanguard's structure is completely unique. Vanguard is actually owned by its funds, and those funds are owned by the investors. So when you buy VTSAX, you become a part owner of Vanguard itself.
That's brilliant.
Right. Your interests and Vanguard's interests are perfectly aligned. Their only mandate is to keep your management costs as absolute low as possible.
That structural advantage is massive over a 30-year investing timeline. Now, what happens when you are nearing retirement? You enter the wealth preservation stage. That's when you start mixing in bonds, specifically a Vanguard bond fund called VBTLX.
Bonds act as a crucial shock absorber. We need to explain how this deflation hedge actually works. When you buy a bond, you're basically lending money to an entity like the government or a corporation in exchange for regular interest payments.
And historically, bonds often move inversely to the stock market.
Yeah, so when the stock market crashes, when the foam is overflowing and panic sets in, central banks usually lower interest rates to stimulate the economy. When new interest rates drop, the older bonds you already hold, which pay a higher interest rate, become highly valuable. Their price goes up.
This means during a terrifying stock market crash, your bond portfolio is likely holding steady or even gaining value. So when you need cash to buy groceries in retirement, you sell your bonds. You don't have to sell your stocks at rock-bottom prices. It protects you from the foam.
Right. And if managing two different funds and rebalancing them sounds like too much work, there is an ultimate shortcut. Target retirement funds, or TRFs.
The one-decision solution. You literally just pick the year you want to retire, say 2050, and buy the Vanguard Target Retirement 2050 fund. Vanguard automatically shifts the balance for you. When you're young, it's heavily weighted in stocks for aggressive growth. As 2050 approaches, Vanguard automatically sells some stocks and buys bonds to protect your wealth. You can spend exactly 0 hours a year thinking about your portfolio.
Asset allocation is covered. But asset location is just as vital. You need to protect this growing wealth from the government through tax buckets.
So the basic buckets are your 401ks, traditional IRAs, and Roth IRAs. The golden rule of the 401k is simple. If your employer offers a match, you always take it. If they match 5% of your salary and you don't contribute that 5%, you are literally walking away from free money as part of your compensation package.
Absolutely.
But the source material highlights a massive, ugly surprise waiting at the end of the traditional tax-deferred rainbow. It's called RMDs.
Required minimum distributions.
Let's walk through the mechanics of this trap. You spend your whole life diligently saving into a traditional 401k. That money goes in pre-tax, lowering your tax bill today, and it grows tax-deferred for 40 years. It sounds great, but the IRS doesn't let you hide that money forever. At age 70 and a half, the government forces you to start withdrawing a percentage of that money based on your life expectancy, whether you actually need the cash to live on or not.
And if you have been a good saver and allowed decades of compound growth, your account balance could be massive. Those forced IRS withdrawals could suddenly push you into a massively high tax bracket in your 70s.
To counter this, the author reveals what I can only describe as a financial cheat code, the Health Savings Account, or HSA.
Yes. When used optimally, the HSA is arguably the most powerful investment vehicle available in the U.S. tax code.
Okay, so to qualify, you must be enrolled in a high-deductible health plan. If you are, you can open an HSA. Here is how the magic trick works. The money you put into the HSA is pre-tax. It lowers your taxable income this year, just like a 401k.
And if you use that money to pay for medical bills, it comes out completely tax-free.
But the wealth-building strategy dictates that you do not use the HSA for current medical bills.
Right, which sounds completely counterintuitive.
Very. If you break your arm today, you pay for the x-ray and the cash out of your regular post-tax checking account. But you save the medical receipt. You put it in a shoebox or you scan it to a cloud drive. Meanwhile, the money sitting in your HSA, you invest it in VTSAX.
You let that money compound entirely tax-free for 20 or 30 years.
Because the IRS currently has no time limit on when you can reimburse yourself for a medical expense, 20 years from now, you can open that shoebox. You pull out the receipt for that broken arm from 2 decades ago, and you withdraw that exact amount of money from your heavily compounded HSA. Tax-free, penalty-free.
You have essentially engineered a stealth retirement account. The money goes in tax-free, it grows tax-free, and it comes out tax-free.
Right.
It is the holy trinity of tax avoidance.
Building the wealth and shielding it from taxes is an incredible achievement, but the final hurdle is protecting it from predators, and the financial world is full of them.
Oh yeah. The book tells an illuminating story about the 1,000 letters scam, also known as the hasn't missed one yet scam. It is a masterclass in weaponized mathematics.
It's brilliantly devious. So a con artist wants to convince wealthy people he has a proprietary algorithm to predict the stock market. So he picks a highly volatile stock. He buys a mailing list and sends out 1,000 letters. In 500 of them, he predicts the stock will go up. In the other 500, he predicts it will go down.
Let's say the stock goes up.
The scammer throws away the list of the 500 people who got the wrong prediction. To the 500 people he got right, he sends a second round of letters about a new stock. 250 say up, 250 say down.
He is just having the pool of targets every single time, letting the math do the work.
Exactly. By the 6th round, he is left with a small group, about 15 people. But put yourself in the shoes of those 15 people. They have just received 6 consecutive letters from a guy who has flawlessly predicted the movement of highly unpredictable stocks 6 times in a row. They think he is a genuine psychic.
They do.
When he invites them to a lavish dinner to invest in his new exclusive hedge fund, they practically throw their life savings at him.
It really underscores a vital rule. Everyone can be conned. People often assume they're too smart to fall for a trick, especially in their own field of expertise. That ego makes you lower your guard.
But there's another, much more common, perfectly legal predator the book warns about: the traditional financial advisor.
Yeah, many standard advisors operate on an AUM model, assets under management. They might charge you a 1% or 2% fee every year on your total portfolio balance.
And a 1% fee sounds completely harmless. It sounds tiny compared to the gains they promise.
That is the illusion. You have to understand how that 1% is calculated. It is not 1% of your profits, it is 1% of your entire total balance, year after year.
Oh, wow.
Over a 30 or 40-year investing lifetime, as your portfolio grows into the hundreds of thousands or millions, that 1% fee is compounding right alongside your money. It acts as a massive drag on your growth.
By the time you retire, that innocent-sounding 1% fee could devour up to 30% of your total potential wealth. You are giving away a third of your life savings for someone to manage a portfolio you could have managed yourself with a single Vanguard index fund. Scraping off the luchas applies to the guys wearing nice suits too.
Which brings us to the finish line. If you follow the path you save, you invest in index funds, you optimize your taxes, you avoid the fees. How do you actually know when you are done? How do you mathematically define FU money?
It comes down to a benchmark known as the 4% rule. This is based on historical data, specifically the Trinity study. The study looked at decades of stock and bond market returns and found a safe withdrawal rate.
The underlying mechanics are crucial here. Historically, the stock market has returned an average of about 7 to 10% per year. Inflation averages around 3%. If your money is growing at 7% and you withdraw 4% to live on, your portfolio is still growing fast enough to offset both your withdrawals and inflation.
The math to figure out your target number is incredibly simple. Take your annual spending, whatever that number is, and multiply it by 25. That is your finish line. If you can live happily on $40,000 a year, you need a nest egg of $1 million. If you spend $100,000 a year, you need $2.5 million.
Hitting that 25x multiplier represents a profound threshold. It means the capital your money generates is now enough to sustain you indefinitely. Your money is finally working harder than you are. You no longer have to trade your limited time on Earth for capital.
Let's connect this right back to the monk and the minister. The lower your annual spending, the faster you reach that 25x multiplier. The more comfortable you are with rice and beans, the sooner you can completely stop catering to the king.
The mechanics are simple, but the mental fortitude is rare.
That is the ultimate takeaway for you today. You don't need to be a math genius. You don't need to be a Wall Street insider. Building wealth requires patience, the discipline to spend less than you earn, and the mental toughness to just ignore the noisy foam of the market.
And we want you to start taking action right now. First, subscribe to Wealth Builder books so you never miss a breakdown. Second, drop a comment below. What is one recurring expense you can cut this week to start building your surplus? And that's all from me.
I want to leave you with one final thought to mull over. Take a second tonight and honestly calculate what 25 times your current annual spending is. Find your exact FU money number. Imagine if you woke up tomorrow, logged into your bank account, and that exact amount was sitting there in cold, hard cash. What is the very first thing in your life you would say no to? Keep that answer in your head. Let it drive you. We'll see you next time.